You know, when people hear my name today, they usually think about stocks, balance sheets, or some rigid set of rules written in old books. But that was never the point. I didn't spend my life studying markets because I loved numbers. I studied them because I was fascinated by human behavior. Markets, after all, are nothing more than crowds of people making emotional decisions and then inventing logical excuses afterward. I was born in 1894, and by the time I reached adulthood, I had already seen prosperity, panic, collapse, and despair. Those experiences taught me something that no textbook ever could. Money does not reward intelligence nearly as much as it rewards discipline, and discipline, unfortunately, is rare. I watched people far brighter than me lose everything because they could not control their impulses. I watched people of very average intellect quietly build fortunes because they understood one simple truth. The market is not a machine that calculates value. It is a voting booth driven by fear and greed. If you allow your emotions to vote, you will always overpay in optimism and sell too cheaply in despair. That pattern has repeated itself for centuries, and it will continue long after you and I are gone. Most people believe money problems begin with low income. That belief is comforting because it removes responsibility. It suggests that if circumstances were different, everything would improve. But after decades of observation, I can tell you plainly, financial failure is almost never caused by insufficient earnings. It is caused by poor judgment repeated consistently over time. Judgment deteriorates fastest when ego is involved. The desire to look successful, to feel clever, to impress others. These urges are far more destructive than ignorance alone. During the Great Depression, I saw intelligent men ruined not because they lacked opportunity, but because they trusted optimism more than arithmetic. They believed markets only moved upward because they wanted to believe it. When prices fell, they called it temporary. When losses mounted, they called it patience. By the time reality arrived, it was too late. That same pattern exists today, only the costumes have changed. What was once margin debt is now easy credit. What was once stock tips is now viral speculation. The language evolves, but human nature does not. People often ask me what investing really is. They expect complexity. They expect formulas. I always disappoint them. Investing is simply the discipline of laying out money, today with a reasonable expectation of receiving more purchasing power in the future, while taking care to avoid permanent loss. Everything else is speculation wearing respectable clothing. The tragedy is that most people do not want reasonable expectations. They want excitement. They want validation. They want to feel smarter than the crowd while doing exactly what the crowd is doing. I've spent much of my life warning people about the danger of confusing price with value. Price is what you pay. Value is what you receive. The difference between the two is where both fortunes and disasters are born. Yet the average person spends more time comparing smartphone models than evaluating the financial decisions that will shape decades of their life. They obsess over short-term comfort while ignoring long-term consequences. They measure success by appearance rather than stability. This is not a failure of intelligence, it is a failure of temperament. Temperament, more than intellect, determines financial outcomes. The ability to remain calm while others panic. The ability to remain patient while others chase. The ability to say no when everyone else is saying yes. These are not glamorous skills. They do not produce exciting stories at dinner parties. But they work. They have always worked, and they will continue to work because they align with reality rather than fantasy. One of the greatest illusions sold to the middle class is the idea that activity equals progress. People feel productive when they are busy, when they are trading, upgrading, refinancing, rearranging, but motion is not improvement. In investing, excessive action is often a sign of emotional discomfort, not intelligence. The most profitable decisions are frequently the least dramatic ones. Buying carefully, holding patiently, and doing nothing most of the time. I learned early on that the primary purpose of investing is not to make you rich quickly. It is to prevent you from becoming poor slowly. Losses compound just as relentlessly as gains. A single large mistake can erase years of careful progress. That is why I always emphasized margin of safety, not as a mathematical trick, but as a psychological defense. When you leave room for error, you protect yourself from your own overconfidence. And overconfidence is the most expensive luxury most people ever purchase. Debt in particular deserves sober reflection. Leverage magnifies outcomes, but it also magnifies emotion. When you owe money, your decisions are no longer entirely your own. Fear enters the equation. Fear shortens time horizons. It turns long-term plans into short-term reactions. Many people believe debt accelerates success. In reality, it usually accelerates stress. Freedom and leverage rarely coexist peacefully. I have seen people mistake debt for intelligence because it allows them to participate in things they cannot truly afford. Large homes, expensive lifestyles, impressive appearances. But appearance is a fragile foundation. True wealth does not announce itself. It whispers. It grows quietly while others are distracted by noise. If you need borrowed money to maintain your identity, then your identity is built on sand. Another misconception I encountered repeatedly is the belief that markets reward bravery. In truth, markets reward rationality. Courage without analysis is recklessness. Caution without thought is paralysis. The balance lies in thoughtful action guided by humility. The investor who survives longest is not the boldest, but the most realistic. They understand what they own. They know why they own it. And they are prepared, emotionally and financially, for periods when they will look foolish for doing the right thing. People love stories of dramatic success. They ignore the years of quiet discipline that made those stories possible. They see the outcome, not the process. That is why they copy results rather than behavior. They chase what worked yesterday instead of building habits that work forever. This is why speculation feels intelligent in the moment and regret feels inevitable later. One of the most damaging habits I observed was the refusal to think independently. Crowds offer comfort. Agreement feels safe. But safety in markets is often an illusion. The moment everyone agrees, prices usually reflect that agreement too fully. Value disappears when consensus becomes extreme. Independent thinking is uncomfortable because it invites doubt and criticism, but discomfort is the admission price for long-term success. I often reminded my students that the market is there to serve you, not to instruct you. Its fluctuations are opportunities, not commands. When prices fall, the emotional investor feels fear. The rational investor asks whether value has changed. When prices rise, the emotional investor feels pride. The rational investor asks whether expectations have become unrealistic. This difference in response, repeated over decades, separates investors from speculators. It is important to understand that wealth is not an end in itself. It is a tool. Its true value lies in the flexibility it provides, the ability to choose, the ability to wait, the ability to walk away. These options are priceless, yet most people trade them away for temporary comfort or social approval. They optimize for the present moment and mortgage the future without realizing it. I have always believed that simplicity is underrated because it denies people the illusion of cleverness. The principles of sound finance are almost embarrassingly straightforward. Live below your means. Invest the surplus prudently. Avoid large mistakes and allow time to do the heavy lifting. The difficulty lies not in understanding these principles, but in applying them consistently while surrounded by temptation and noise. Time is the most misunderstood element in finance. People respect it in theory but ignore it in practice. They want results now. They underestimate how powerful small, sensible decisions become when compounded over decades. And they overestimate how forgiving time is to poor decisions. Time magnifies whatever you feed it. Discipline becomes freedom. Negligence becomes regret. I have seen markets recover from wars, depressions, political chaos, and technological upheaval. What they do not recover easily from is human folly. Panic selling, euphoric buying, blind imitation. These behaviors leave scars that no recovery can fully erase. That is why the most important investment you will ever make is not in a stock or a bond, but in your own temperament. The modern world encourages constant stimulation, alerts, headlines, opinions, predictions. All of it creates the illusion that something must always be done. But intelligent investing often requires ignoring most of what you hear. Silence is a competitive advantage. The ability to sit quietly while others react emotionally is rare, and therefore valuable. If there is one lesson I wish more people would internalize, it is this: you do not need to be extraordinary to achieve extraordinary results. You need to be consistently reasonable. Avoiding stupidity is more powerful than chasing brilliance. Most financial disasters are not caused by bad luck, but by bad behavior repeated long enough to feel normal. When I look back on my life, I do not measure success by the wealth accumulated, but by the mistakes avoided. Each avoided error preserved capital, confidence, and clarity. That preservation allowed compounding to work uninterrupted. Compounding, after all, is not just a financial concept. It applies to habits, character, and judgment. Small improvements, repeated faithfully, create outcomes that appear miraculous to those who seek shortcuts. People often ask whether it is too late for them. It rarely is. The moment you choose rationality over impulse, discipline over display, and patience over excitement, you change your trajectory. Markets do not require perfection. They reward persistence. They forgive humility. They punish arrogance without mercy. I never believed wealth was about beating others. It is about mastering yourself, your fears, your desires, your impatience. Once you understand that, money becomes less mysterious and far less emotional. It becomes what it always was meant to be, a servant, not a master. So if you are searching for a secret, I will disappoint you again. There is none. There is only the quiet power of rational thinking applied consistently over time. It is boring. It is unglamorous. And it works. It worked in my lifetime. It will work in yours. The challenge is not whether these principles are true. The challenge is whether you are willing to live by them while others chase noise. That choice, repeated daily, is what ultimately separates financial anxiety from financial freedom.